So we are going to carry on with a conversation around building climate resiliency. Yes, please do come up. We have a good-sized panel for this session today, and so I apologize, I didn't check this. Arijit, yes. Arijit Banik, the treasurer at York University, Kevin Quinlan, Senior Director, Climate and Client Strategy at SLC, Ailey Roberts, Global Head of Sustainable Investing at BGO, and Catherine Jackman. So I'll turn it over to you. Thank you.
Check, check. Oh, wow. Okay, that's loud. Can you hear me okay? Is it too loud? They put the mic in my hair, so I feel like I'm E.T. I've got this thing in the back, so if I give a strange look, it's not you. So thank you very much, everybody, for joining us, and people for FENI for having us.
Sitting awkwardly with our water.
As my colleague mentioned, I'm from SLC Management. So if you haven't heard of us, we're Sun Life Capital. We're Sun Life's institutional fixed income and real assets manager. So we manage about $375 billion. And we work with clients to understand their investment needs. And one of the big topics that's come up in recent years is climate. And it's got to do with regulations, changing market conditions, weather patterns, things that people are experiencing in their everyday lives. So as a manager committed to net zero asset management, we're part of what's called NZAM. We are helping clients with their decarbonization goals. We're also part of the PRI, which is the UN-sponsored Principle of Responsible Investing. So that's a mouthful of a lot of things. But really, you're probably here wondering, okay, what's that got to do with endowments? And so today we want to talk about how endowments are working with their stakeholder groups. And so we thank Arijit from York, who runs the endowment over there at the university, for speaking with us, how they are managing climate risk, how to think about it, how to get started. So as my FENI colleague mentioned, we've got Ailey from BGO. That's our real estate affiliate. So she's the global head of sustainable investing. And Kevin Quinlan is my colleague from SLC. He's our director of climate, so all things climate related. So now this is a tough act here, right? So we talked about these chairs before we got up, and I thought, you know, guys, I don't know if I can sit on this chair, right? I'm like, oh my gosh. So I'm sort of hiding out over here by this stand. They're kind of in the hot seat, but we'll probably, move it around a little bit. We're gonna take some questions from the audience once we kind of get the conversation flowing. So that's the idea, is we're gonna talk amongst ourselves. Hopefully this will generate some ideas for you. I think we have about a half an hour, so really engaged in conversation. Got a lot of brain power up here with me, so I thank you all. Okay, so Arijit, we're gonna start off with you, especially for most people in the room. They're most relevant thinking about, like, how does an endowment or foundation think about it? Can you tell us, how does your organization think about climate from an investment perspective? I'll let you start off.
Well, when you were mentioning brain power, I knew that wasn't about me. But I'll apply it anyway.
Okay.
When you look at sustainable investing in general, climate in particular, at York, we have say the market value of our endowment right now is about $630 million. So it's fairly big, but we still are resource constrained. We don't have a lot of staff. I rely heavily on consultants to help me, and I also rely heavily on an investment committee to be real aligned with our thinking on this. And when we talk about climate in particular, I just want to get a couple of definitions out of the way, just so that I'm clear about what I'm talking about. So we focus on the climate transition, but there's a climate transition, there are a couple of them. They're concurrent. So there's the decarbonization of the electric grid, and then there's also electrifying what is considered primary energy source. Primary energy sources being primarily oil, but also coal, into forms where it's electrified. These are incredibly difficult things to do. So that's one part that's kind of looking forward. Looking backward, we have to assess climate risk, and we assess climate risk at the university by being very transparent in terms of our reporting. You can just Google York University Investment Committee. You will see the links to all of our sustainable investing reports, and we report on what the carbon emissions are for all of our equity managers and all of our fixed income managers. So that as just the first stop is how we're thinking about it in a backward-looking way.
And would you say that that has evolved over time, like especially the senior leadership of your organization? Like, have they changed their views? Because sometimes I think many in the room, climate and how we manage things in portfolios can mean different things. It can mean not having things, so exclusions or screens. It can mean thinking about risk integration. Like, has your organization, your leadership, changed in their thinking over time as you've been on this journey?
I'm incredibly thankful that it has changed.
Okay.
So I got to York in 2018, and prior to that time, all of the narrative around climate was around divestment.
Okay.
Negative screening. That's definitely evolved over the years because we felt that it's really a slippery slope to go down the divestment route and constantly have everything framed in terms of what you can't include. We prefer to go down the path of positive screening and looking at the climate risk of the portfolio through ESG metrics, and also looking at opportunities to invest, to be climate aligned, Paris aligned. So as a first stop, when we started along the path of infrastructure investments, as an example,
Yep.
All of our infrastructure investments have been with Article 9 funds, with the EU SFDR. So they're really, their mandate is to be investing with the point of being climate aligned and reducing.
Got it. Okay. So that sort of leads us into my next question. This one, Ailey, for you, when you think about the questions that you're seeing from the endowment foundation investors that you deal with, what kind of things are they asking you, and what do you think is driving these questions?
Yes. Demand is certainly increasing exponentially. Even from 3 years ago, we've seen such a focus on this topic coming from our investors, not just from endowment funds, but globally across our portfolio. A lot of it is being driven, I would say specifically maybe in the endowment fund context, from their own internal net zero commitments or their own sustainable investing policies. And that's really focused around risk mitigation. So I think investors are really coming around to acknowledging that climate risk is really investment risk, and they're trying to future-proof that capital, protect that capital from the different climate risks that we're facing and materials to their portfolio. I would say more broadly, though, regulation has certainly driven the focus on this quite significantly. Speaking from, of course, the European context, the European market and the regulations there under their sustainable finance sort of program, that has driven demand significantly. Investors are, they have their own sort of SFDR or Sustainable Finance Disclosure Regulation. Apologies for
Thank you. I was going to jump in. So
the plethora.
SFDR, if you're listening closely and you haven't
Yes.
zoned out in the middle of the afternoon after lunch. So thank you, Ailey. Keep
Apologies
going.
for the plethora of alphabet soup here. But they have their own requirements under the regulation, which are then imposed on the funds that they invest in. So, we may not be domiciled in Europe, but we have Canadian investments. We're still subject to those requirements from our investors. So we're seeing an increase specifically around data and disclosure. We're getting questions around our emissions calculations. We're having to quantify those emissions where we really didn't have to before. We're being asked for that from our investors. So certainly data quality is important, but also data coverage. So, we're using, specifically in the real estate context, we have the benefit of having access to real performance data from our buildings. Where we don't have that access, we are leveraging proxies or estimations, but by and large, we do have better quality data, which is quite favorable to our investors, and we're getting positive feedback on that.
And that's sort of a very tangible thing, right? So we think about real estate, and we're going to throw this next one to Kevin, who deals with all different asset classes, because I think real estate is something everybody can kind of get their head around. We were talking about this in the prep, this sort of certified buildings and things like that. I guess, Kevin, from your perspective, again, you have a broader lens across the asset class suite. When you think about different ways that foundations and endowments can pursue their climate objectives, and again, we're trying to focus it as it pertains to investments for the scope of this discussion. Can you talk to us about how some of the folks you're talking with are thinking about it and discussions you've had?
Yeah, for sure, happy to. So I would say we certainly see a range of what clients are asking for in the climate space. And I think that really reflects, in a lot of ways, just a recognition that depending on what you're invested in, there are very different levers for climate impact across different asset classes. So, for those who are maybe sort of earlier stages thinking about what's out there and trying to understand maybe where they want to go, I always like to sort of simplify it broadly into sort of two buckets. And both Arijit and Ailey touched on this, which is that you've kind of got one sort of bucket of things that are, like the reductions or the exclusions. So, a lot of clients will set targets to reduce the emissions intensity of a portfolio or things like that. But then on the flip side, you also have another bucket, which is sort of allocations towards, the positive. So we're going to set a target to put more into renewables or transition assets, or we want a share of our portfolio to be in companies that we consider to be aligned to net zero. And those are two very different approaches. And some clients have one versus the other, sometimes they have both. But it can vary, obviously, depending on what you're investing in. Mm-hmm. And so, for example, a public bond portfolio is pretty common for those clients who do have climate commitments. They'll say, okay, we want to reduce, the carbon intensity by 40%, 50% by 2030. That's kind of a common approach. So what does that look like from an asset manager standpoint? That's going to be, not just like a blanket divestment, but, the way we'd kind of look at it is say, okay, we're going to look at these sectors that are carbon intensive, and who are the ones within that sector that are still going to achieve our investment objectives, but they have credible plans to decarbonize. We think they have pathways to reduce their emissions. They operate in jurisdictions that enable this. That's kind of a common approach. But then also, we do a lot in the private fixed income space, and so that's an area where you start to look more at where are you allocating long term. So if it's a buy and hold strategy for a fund, you start thinking about how can you get exposure to renewables, energy efficiency projects, battery storage, things like that. And those are obviously very different approaches. And Ailey touched on the real estate side. And, real estate's obviously really appealing from a climate perspective because, people can really wrap their heads around it, and you can point to direct emissions reductions. You can say, we took this building, and here's our plan, and here's how we're going to reduce the emissions. So there's different ways to approach it, depending on what clients are looking for. And I would just to close out that thought, I think one of the things we really try to emphasize is that, when we get asked about these things, we don't have any clients who are asking or coming to us with climate commitments who are leaving money on the table or saying they're sacrificing investment returns. The climate commitments go sort of hand in hand with them, and they expect us to achieve those in line with the investment objectives. And sometimes people assume there's going to be a trade-off, and it's not. The expectation is that they go together. So.
Right, and that's a different thing. And again, these buzzwords, you hear things like impact and ESG and climate, and so sustainable. I think even as an industry, we're trying to do a better job to help our investors understand just what is it that you're talking about. We didn't exactly touch on it here, but you hear people talk about certain kinds of companies, like could you invest in those? And it turns out, yes, some of what might be kind of bad or negative sounding companies, they are going to be part of the solution. So I think that's a shift I've observed over the years, and in discussions with the group here.
Catherine, can I go rogue and make a point?
Oh, please get in
Okay.
there.
So what both
Ailey, yeah?
Ailey and Kevin have mentioned, they're spot on. I think it's important to state that if you're making these decarbonization commitments, to be really flexible about them, because you're going to have very skewed portfolios to just high growth assets if it's just purely based on decarbonization. The greatest opportunities are actually going to be in traditional deep value areas such as industrials, where there's going to be a lot of potential upside. And if they don't those companies don't adjust, then they're going to be dead carbon assets in the future. And I'm not doing this as a plug for BGO, but the report that I got from them last year, it was a 21-page report on actual GHG methodology.
And just for the audience, can you tell us what that is? That's greenhouse gas emissions.
Yeah,
Yep.
so the greenhouse gas emission, just the
Sure.
methodology. And then for the prime portfolio, it showed scope 1, 2, and 3 emissions on both market-based and location-based.
And again,
So-
the scopes, just tell us again what those things, that's
well,
basically.
they couldn't explain it better
So
than
Ailey, just quick jump in on scopes, just like little high level. It's just degree of how much you're chasing down through your supply chain, right? 1, 2, 3.
Yes, so scope 1 will be our direct emissions, so emissions from fossil fuels burned on our sites. Scope 2 being emissions generated off-site but brought to our sites. You can think about that in the context of the electricity grid. And then scope 3 being all of sort of your value chain, downstream lease assets, embodied carbon, etc., wastewater.
Yeah, and it's important because I don't want to be reporting on proxies for our real assets. I want to be reporting on the actual emissions
Very good
data.
point, right. You want to be a little closer to it. And I think that's something that has shifted over time. Like many investors have certain needs, certain obligations. I know many people in this audience, right, their spending requirements, they don't go away, even as sometimes I think we feel that they are sometimes in challenge with the sort of values of the organization. So we do deal with investors that I think have these kind of what could be on the surface conflicting interests, and so it's trying to balance those. Okay, we're gonna, as I sort of jumped in a bit as we talked about buzzwords and acronyms, which, the sector quite enjoys those, but, speaking to the people that are here, and I think there's probably a wide range of experience and exposure. Can you give our group some idea, because we did promise that we would give you some tangible takeaways, right, before you decided to join us and share and give us your time. So we thank you for that. If a group was overwhelmed, or perhaps I've talked to people where they're like, holy heck, I've been mandated with this thing. I'm not even sure I know what it means. And they're trying to do it off the edge of their desk. Can you speak to the group here? I'll start with Arijit. Where would you suggest that people start if they're sort of on this journey trying to figure out what to do?
In terms of nomenclature, when I'm writing reports internally for our investment committee, I'm always going back to the US EPA because they have actually a good glossary of terms.
Okay.
But that's just one of many.
Okay.
From my perspective, I would say the PRI, or Principles for Responsible Investing, is an excellent framework and sort of best practice tool and resource for asset owners, asset managers, anybody who's either just getting started in their journey or further advanced along their responsible investing journey. BGO specifically participates in the Real Estate Advisory Committee, so there are sort of individual committees that are focused on each asset class, and you're able to sort of dig into sort of best practices and help inform the discussion around these topics.
Okay. And Kevin, anything you would?
Yeah,
offer?
I would say start with a conversation with your asset managers. And that kind of goes back to an earlier point I made, which is that, again, the levers you have are going to be very different across the different asset classes. So talking to them around, what they see, what the opportunities are. Often just a conversation on reporting is a really useful way just to open up the conversation and just understand, okay, what can they report on? And what does it mean, right? There's obviously a lot of focus on reporting in this space, but it's not it shouldn't be reporting just for reporting's sake. It should be, providing information that's material and useful for what your objectives are. And so from a climate perspective, I'd say start there with the asset manager, ask about that. What can they do on reporting? How do they think about public fixed income, private, infrastructure, real estate? There's going to be different ways that they can approach that, and I think that's a really good jumping off point to think about that.
And of course, we're seeing the regulators, not necessarily to this group, but our parent company is Sun Life, and Kevin, maybe just, this is not an insurance audience, can you speak to some of the changes, just to indicate the biggest institutions in Canada are now being given this task, you just give us a couple of highlights from some recent.
Sure. So
B15.
do I get like 3 hours to go through the new regulations?
Just to give frame of reference. So 3 minutes?
Broadly speaking, the big sea change in Canada is that, so OSFI, the financial regulator for federally regulated banks and insurers, is requiring a broad range of new climate disclosure reporting requirements. Some of them are staggered depending on the size of the institution. Others are coming in all at the same time. If you're familiar with the TCFD, Task Force on Climate-Related Financial Disclosures, which is a framework, although formally wrapped up, it's effectively the existing framework for how to be reporting on climate risks and opportunities. It's based around that. But what it's doing is it's really triggering a lot of effort and internal capability building around things like reporting, and that's not just reporting on just emissions or things like that for investments. That's reporting and really understanding how is climate risk assessed within an organization. Who's responsible for climate risk? How do we think about climate risk? Where does it sit in the organization? Is it siloed or is it actually integrated across different risk categories? So there's a big movement there to get ready for that and to start doing reporting around that. It's really led to I'd say a sea change.
It's
in
big.
that
I
space.
mean,
Yeah.
you're a full-time climate person based in an organization. And we mention this because as we've seen, for some of us who've been doing this a while, like as bigger investors get impacted and, frankly, forced to do things, then things start to follow suit. And so whether it's getting access to information, having people become expert in these fields, the good news is for the audience here, the hope is that this would help you on your journey as, there's more pressure on certain organizations to provide this. And so we start to get a common language around how we measure that. Because that's something I have heard, this group talk about is, and I think Ailey, we talked about it in the preparation, it's this idea of making things apples to apples, right? And so whether it's some of the, units of things, and Kevin, we talked about this as well, because otherwise it's how does it change? And Arijit, I did look at your report before the session. It's great. If you haven't gone online, not to do the plug for York University Endowment, but it's really nice, and it's nice graphics, and it's very tangible. Because I think the biggest risk on this is over-information, right? So we don't want to bury our investment committees, our boards, our senior leaders with all kinds of jargon and things. They're basically like, what are our stakeholders needing? What are we doing? And how are we moving towards that goal? I mean, that's probably something that anyone who's a senior leader in an organization is thinking about, depending on what they're measuring. So similar thoughts there. Okay, we've got a few more things to take from the group. So start thinking about your questions, because we're going to have probably just 3 or 4 minutes at the end. I'm going to ask the panelists a little bit more, and then we'll be ready to take questions from the audience. So Arijit, for you, what do you think is a misconception when we talk about climate and investing?
For me, the biggest misconception is having this massive overlay of environmentalism over it. Okay. The double materiality is important.
Okay.
So yeah, we want financial returns, but we also care about the planet and the people and the impact. But the investments still have to be good investments. With these investments comes risk.
Okay.
And you have to determine what level of risk your organization is willing to take. So, as an example, York's committed a fairly large ticket to greenfield green hydrogen projects in the EU, which are power to X. So it's essentially it's helping to decarbonize hard to abate sectors.
Okay.
But in order for that to be economically feasible, it also requires funding from the EU and grants and the taking off of the hydrogen offtake market. So none of the stuff's easy, and it's not supposed to be easy. If it was easy, then everyone would be doing it. You have to determine to what level you're willing to go, and the decision has to be done from the basis of good investment principles.
Okay, that's great. Ailey, we'll let you wade in with some things that you've seen or misconceptions that come up in discussions with folks.
Yeah, I would say one of the biggest topics of discussion sort of internally is the definition of net zero and how markets are defining it within Canada, US, Europe, Asia, all these different markets, and how to really define it in the real estate context, but you can even apply it, of course, more broadly to other asset classes. Specifically for real estate, we have to make sure we're comparing things apples to apples, as you said, Catherine. We have to look to external benchmarks or third-party frameworks and standards to help us kind of define what that means in order to all speak the same language. We at BGO, similar to SLC, we are a signatory to the Net Zero Asset Managers Initiative, which does have sort of very clear stipulations around the use of things like carbon offsets. And that does, of course, trickle down to our real estate assets. We have the benefit here in Canada of leveraging a third-party certification through the Canada Green Building Council called the Zero Carbon Building Certification. Okay. And that allows us, when asset owners or managers are marketing their sort of net zero assets, we have to kind of look at the underlying definition of it. What does that actually mean? Does it include embodied carbon or not? Does it include operational emissions? More likely it would, but sort of downstream it gets a little murky. So it's really important to kind of look to those standard definitions.
That's great. Kevin?
Yeah, I mean, I touched on the point earlier that there's often the misconception that when you're talking, if someone's saying, oh, climate or net zero, that the default is, well, that must mean exclusion, that must mean automatic divestment. I'd say there's a bit of a misconception there. As well as the idea that it's, there's a charity case that, if they're saying that commitment, it's because they're willing to take lower returns. And that's definitely not the case at all. So I think that's certainly one of the things we emphasize there.
Okay. All right, so we're going to pause there. We have about 5 minutes left. We're going to look to the floor and see if anyone has any questions they want to raise with this group. Anyone? Okay, wow, I know that we had one that was discussed before. Certainly markets outside of Canada. Ailey, you touched on a little bit where you said European markets are quite advanced in their thing, in their sort of regulatory framework. And I think we know that, they're going to be the first group to designate a common charger, okay? So that's going to be great for everybody. Have you all been driven crazy with those different chargers for your electronics, right? So the EU is mandating that in the next 2 years, and then we think it's coming to North America. Okay, moving away from that. So things like emerging markets, some people will say, well, how do you handle when you get further afield? Kevin, I think you had some comments on that we were talking about.
Yeah, I was fortunate to go with a colleague we visited a couple of our offices in Asia and met with the investment teams there and talking about how we're approaching climate and ESG here and how they view it and what they're seeing in the market. And certainly one of the big pieces is data, obviously. So getting access to high quality, timely GHG emissions data can be a challenge depending on how far you go, obviously is a piece there. At times, maybe some of the regulations in some areas are not as advanced. But actually, an interesting takeaway I'd say we found, and we met with some of the different regulators in Malaysia, in the Philippines, and Hong Kong, and in some of them, they're actually, I would say, when it comes to for those who follow in Canada, the big debate around the sustainable finance taxonomy, transition. What is the transition asset or a green asset? A number of the jurisdictions in emerging markets are much more advanced than I think often people recognize in terms of setting some pretty clear definitions of kind of what's in, what's out. And so, each one is unique, but I think that was an interesting, sort of challenge, but also an opportunity we found there. Okay.
Did you want to add anything? I didn't want to cut you off. Okay. All right. So I think we're coming up to, sorry, do you want
to add something?
Okay, go for it.
It'll be an unpopular opinion, but for one, okay, we see the EU as leaders, but there's also a lot of hypocrisy in terms of how the EU does things, because to enable a climate transition, we need to do a lot of mining. The EU does not want to do any mining. The EU is very, very happy to just kind of ship everything off to East Asia and have everything done, manufactured there. In the West, we have drastically reduced our emissions and our carbon intensity, but we've also shifted so much of our manufacturing to Asia. Yeah. So for things like photovoltaic cells. We invested in one particular solar cell company and infrastructure company that guaranteed that they were going to have a clean supply chain, which is, those things are important.
That's a
because
lot.
every district, every jurisdiction has different levels of how they consider good ESG.
Right, and how do you make sure it's holistic in approach? Okay, so we're getting up close to time. What I'm going to do is call once more for questions, and then I'm going to give you some summary points to take away and think about.
There's one here.
Oh my gosh. We're going to go over time. You should go for your break now. I'm just kidding, please, if you give it.
Not a question, but a comment.
Mike.
CAMH Foundation. I just want to thank all the investment managers for tackling this, because what we've seen is sharp increase in climate anxiety in our children. And I think this is going to go a long way in not just educating our current investors, but future investors as well. So just a huge thank you.
Well, thank you very much. Okay. So I think that wraps up our session. I'm going to leave you with 3 takeaway points. We did say that we would give you something concrete to think about. The first thing is there's a lot of data. There's a lot of information out there. The good news is that the terminology is becoming more common. The base cases around measurement are becoming more common. The second thing is that having climate objectives doesn't mean that you have to sacrifice investment returns. And so if this is a topic that's been a bit challenging to raise, there are more tools and there's more motivation out there, I think, now than ever to solve these things simultaneously. And the other thing, and the last parting word, is that if you're confused on the whole topic and or you're still evolving in your thinking and your journey about it, there is help. So things like the PRI, the Principle of Responsible Investing, that Ailey mentioned, is a very good website. It explains what managers do. And then more concretely, if you're already working with an investment manager or some of us who are in industry, please ask us, please ask your investment manager for help. Most people are thrilled to talk about it. They're experts in their field. We do a lot of work on it. We're happy to share it, and we thank you for your acknowledgement and your time today. Thank you very much.
Thank you.
Thank you, panel.
There's also one upstairs we all have to share.